Polymarket Bets. 71 minutes before the first bombs hit Tehran, an anonymous account called Mogami Man placed an $87,000 bet on a platform called Polymarket. The bet was simple. Would the U.S. strike Iran by February 28th? At the time, the platform had it at a 17% chance. By morning, that bet was worth over $553,000. For anyone unfamiliar, Polymarket is a prediction market, basically a betting platform where you wager real money on whether real-world events will happen. Will there be a rate cut? Will a certain politician resign? Will a country get bombed? You buy shares at whatever the current odds are, and if you're right, you cash out. So Magamiman wasn't the only one. Blockchain analytics firm Bubble Maps flagged 6 accounts total that all did the same thing. Bet on the exact date of the strike, hours before it happened. All 6 were freshly created. None had any betting history. All were funded within hours of the attack. Combined profit, $1.2 million. One account bought shares at roughly 10 cents each. Those shares paid out at $1. That's a 10 times return on a military strike. In total, $529 million was traded on Polymarket contracts tied to the timing of the Iran attack. $500 million wagered on when bombs would fall. Now here's the part that makes this really uncomfortable. Donald Trump Jr. sits on Polymarket's advisory board. His venture capital firm has invested tens of millions into the company. Both the Department of Justice and the Consumer Financial Protection Bureau had active investigations into the platform. And both ended after Trump returned to the White House. This also isn't the first time this has happened. In January 2026, a fresh account made over $400,000 betting on the capture of Venezuelan President Maduro, hours before U.S. forces seized him. And Israeli prosecutors already indicted an IDF reservist and a civilian for using classified military intelligence to place bets on Polymarket during the June 2025 12-day war. They made over $150,000. Polymarket's CEO has said that insiders having an edge is a good thing because it improves price accuracy. Critics say it's legalized insider trading with a blockchain wrapper, a platform where anyone with advanced knowledge of military operations can turn classified information into cash. Under U.S. commodity trading law, making trades based on death and war is supposed to be illegal. But Polymarket operates offshore, largely outside U.S. jurisdiction. Someone knew bombs were coming. Like they placed their bets, they got paid. War insurance. Nobody is talking about this one, and that's exactly why it matters. Lloyd's of London is the world's oldest and largest insurance marketplace. It writes over £52 billion in annual premiums. And buried inside Lloyd's is something called the Joint War Committee, a small group that decides which parts of the world are too dangerous to insure at normal rates. When they add a region to their list, every ship sailing through it suddenly costs dramatically more to insure. And if the premiums get high enough, the ships just stop going. That's exactly what happened. During the Houthi attacks on Red Sea shipping, war risk premiums increased 20-fold. Not doubled, not tripled. 20 times higher. Ship operators looked at the insurance bill and said, "We'll go around Africa instead." That adds 2 weeks and millions in fuel costs to every voyage. Then Iran closed the Strait of Hormuz in March 2026, and the whole insurance architecture fractured. Analysts started calling it an actuarial blockade. The idea that you don't need missiles to shut down a shipping lane. You just need insurance premiums high enough that no one will sail through it. The effect is the same. The cargo doesn't move. Here's why this matters to you personally. Every container ship that reroutes, every premium that spikes, every voyage that gets canceled, that cost gets passed along. It shows up in the price of electronics, food, clothing, anything that crosses an ocean. You're paying a war tax on your groceries and you don't even see the line item. There's also a completely separate market for kidnap and ransom insurance, worth roughly $250 to $300 million a year. About 75% of Fortune 500 companies hold policies. If an executive gets taken in a conflict zone, the insurance pays. That market grows every time a new war starts. War insurance is the most invisible way that conflict reaches your wallet. Nobody campaigns on it, nobody protests it, but everyone pays it. Surging stocks. March 2nd, 2026. First trading day after Operation Epic Fury launched. Here's what happened before lunch. RTX, that's Raytheon, gained 4.7%. Northrop Grumman rose 4.1%. Lockheed Martin climbed 3.1% to an all-time high of $676.70. That stock was up nearly 40% since January alone. Combined shareholder wealth creation for just those three companies in one single trading day, $25 to $30 billion. Billion with a B. The iShares. Aerospace and Defense ETF, which lets retail investors bet on the defense sector as a whole, surged 35% total since the first U.S. strikes on Iranian nuclear facilities. If you'd put $10,000 into that fund in January, you'd have made $3,500 by early March. Just by owning a piece of companies that build the things that kill people. Palantir Technologies gained 5.8%. They provide AI-powered targeting and logistics software to the military. Their stock essentially goes up when their software gets used more. And it gets used more when there's a war. Every bomb that drops is a line item on a government contract. Every contract flows to a company with a stock ticker. Every stock ticker has shareholders who watch their portfolio go green in real time while the news shows explosions. The market didn't just react to the war, it celebrated it. Oil shock. The Strait of Hormuz is a narrow waterway between Iran and the Arabian Peninsula. Every day, 20 million barrels of oil pass through it. That's 20% of all global petroleum and 20% of all liquefied natural gas. On March 4th, Iran closed it. Brent crude, which was sitting around $65 to $70 a barrel, spiked to briefly touch $120, almost doubled. At the gas station, national average prices jumped from $3.10 to $3.88 per gallon. In California, it blew past $5. Goldman Sachs estimated that $13 of every barrel was pure war risk premium, not based on actual supply and demand, just fear and uncertainty baked into the price. Now here's who benefited. ExxonMobil stock rallied roughly 30% in 2026 to record highs around $159 a share. Rystad Energy, an independent research firm, estimated that U.S. shale producers could pocket an additional $63 billion in free cash flow if oil stayed around $100 a barrel. That's not revenue, that's free cash flow, the money left over after all expenses. So when you're paying an extra dollar per gallon and it's costing your family an extra $50 to $100 a month just to drive to work, that money is going somewhere. It's going to energy shareholders having the best year they've had in a long time. Your pain at the pump is their quarterly earnings beat. Arms deals. In May 2025, Trump flew to Riyadh and signed what was described as the largest arms deal in history, $142 billion to Saudi Arabia. The companies involved read like a who's who of the defense industry: Lockheed Martin, Boeing, RTX, Northrop Grumman, General Dynamics, General Atomics. That deal alone would have been the story of the year. Then the Iran war started and everything accelerated. The administration used emergency powers to fast-track $16.5 billion in weapons sales, completely bypassing congressional review. Normally, major arms deals go through a notification process where Congress can raise objections. Emergency waivers skip that entirely. The weapons go out and nobody votes. Here's the breakdown. $8.4 billion to the UAE, including a $4.5 billion THAAD radar system from Lockheed Martin. $8 billion to Kuwait, like $70.5 million to Jordan. Saudi Arabia separately purchased $3.5 billion in AMRAAM missiles and $100 million in APKWS guided weapons. Total Gulf arms sales accelerated to roughly $23 billion. SIPRI, the Stockholm International Peace Research Institute, which tracks global arms flows, found that Gulf Cooperation Council states accounted for 20% of all global arms imports between 2020 and 2024. The United States supplied half of every weapon flowing into the Middle East and North Africa. War creates the demand. Emergency powers remove the oversight. And the deals get signed before anyone who might object even gets a chance to read them. Hedge funds. Commodity hedge funds don't drill oil. They don't build missiles. They don't fight anybody. They trade contracts on the price movements that wars create. And in early March 2026, those price movements were extreme. RCMA Capital's Merchant Commodity Fund returned 9.5% in a single week through March 6th. Year to date, they were up 20%. Stater Capital, which manages $2.7 billion, gained 6.25% in 1 week. Sabre Capital gained 6.7% in that same window, bringing their 2026 returns to 12%. To put that in perspective, most retirement funds aim for 7 to 10% per year. These funds were doing that in a week. The key thing to understand is how these funds are structured. They're not just betting that oil goes up. They're positioned to profit from volatility, meaning they make money whether prices go up or down. As long as they move fast and hard, a stable, peaceful world is their worst-case scenario. A world where a strait gets closed and oil doubles overnight? That's the dream. For the rest of us, the Iran war means higher gas prices, supply chain disruptions, and economic uncertainty. For commodity hedge funds, it's the best quarter they've had in years. The more unstable the world gets, the better their returns. Gas pipeline. Oil got all the headlines, but the quieter winners were the LNG exporters, the companies that ship liquefied natural gas. 20% of the world's LNG flows through the Strait of Hormuz. When that became a war zone, European and Asian buyers had an immediate problem. Where do we get our gas now? The answer, overwhelmingly, was the United States. American LNG exporters stood to earn nearly $1 billion more per week just from elevated prices. Same gas, same ships, same infrastructure, massively higher margins. This isn't even a new pattern. During the Ukraine war, Cheniere Energy, the largest U.S. LNG exporter, showed exactly how it works. Profit on a single shipment from the U.S. to Europe jumped fivefold. A voyage that used to net $17 million started netting $102 million. Same tanker, same route, 5 times the money. The Iran conflict replicated that at an even bigger scale. GCC oil and gas production dropped by over 10 million barrels per day, equivalent by mid-March. That's one of the largest supply vacuums in energy market history, and U.S. exporters rushed to fill it at premium prices. Every time a choke point closes or a producing region destabilizes, the same thing happens. The supply shrinks, the price spikes, and the exporters who are furthest from the conflict zone cash in. Geography is the advantage. War is the catalyst. Lobbyists. On March 9, 2026, Senator Lindsey Graham went on Fox News and said this about the Iran war. When this regime goes down, we're going to make a ton of money. He wasn't speaking hypothetically. Graham has received roughly $2.1 million from defense corporations since 2018. About $55,000 of that came directly from Boeing's Political Action Committee. Boeing, the company that just signed an $18.8 billion fighter jet deal and a $6.8 billion munitions package for the region. That's the senator who champions the war, funded by the company that supplies the weapons. But Graham isn't unique. He's just the one who said it on camera. In 2024, the defense industry spent a record $159.2 million on lobbying, funding 950 lobbyists. Over the past decade, the total is nearly $1.3 billion. In defense PACs handed $12.78 million directly to federal candidates in the 2023 to 2024 cycle alone. 7 of the top 10 recipients in the House sit on armed services committees, the committees that approve defense budgets and authorize weapons sales. Researchers found that members of Congress who voted for military spending increases received 3 to 7 times more defense industry money than their colleagues who didn't. 3 to 7 times. The correlation between taking defense money and voting for defense spending is one of the most consistent patterns in American politics. The people who vote for war are funded by the people who sell the weapons. That's not a conspiracy theory. It's not speculation. Every dollar is documented in public filings with the Federal Election Commission. You can look it up right now. The system isn't hidden. It's just so out in the open that most people assume it can't be as bad as it looks. It is.